Greetings, everyone. We're going to take a few minutes and allow the Zoom conference to populate with attendees. Okay, it's 12:05. We'll go ahead and get started. I know that everyone's busy and they've got a lot on their plate right now. Really appreciate everyone attending our Zoom teleconference and video conference. Those of you who are on a phone, welcome, and those of you who are on video, welcome. And please note that questions can be submitted on Q&A, on your Q&A bubble in the bottom of the screen. I'll take a moment and tell you that your board and the chapter really appreciate your attendance, and we've put together a wonderful panel that's informative and is going to provide some insight into our current economic conditions and also a forward look to help you to plan and ameliorate for your clients to provide the excellence of consultation. First of all, today we have Mark Broughton with Merrill Lynch, Erich Guenther with Glacier Real Estate Financing, Jack Weiser with Bank of America. Jack is a senior relationship manager. Erich Guenther is a principal in Glacier, and also many of you know him from his excellent work in commercial mortgage and commercial finance. Mark is a wealth manager advisor and will provide some insight in equities markets. We want to thank today our Power Partner sponsors: Ameriprise Kevin O'Keefe, Benaroya Larry Benaroya, Williams Kastner Rob Sargent, Rowley Properties Kelly Richardson, McConkey Development Fred McConkey, our in-kind and media sponsors, Daily Journal of Commerce, The Registry, and BDP Design, Kelly Beckley. A few housekeeping items. To minimize the external noise, all attendees are muted. However, we highly encourage questions and comments. If you have a question, please submit them to Q&A forum and when the topic begins. In the Q&A forum, you will be able to upvote questions. Upvoting will help us prioritize your question. If you are having technical difficulties with the webinar, please call 1-888-799-9666, extension 2. For Zoom tech support, Zoom should be able to help you maneuver through troubleshooting options. However, due to increased volume at Zoom, you may not be able to get through. If this happens, try logging out of the webinar and logging back in. We are recording the webinar and it will be available on demand on the CCIM-WA.com website later this week. Chapter announcements, quick briefing of the state of the state, local chapter announcements, presentation format, Q&A after each section. Please hold your questions until the section started. So Jack Wise will lead us off today. Jack Wise is going to frame his comments and guidance around institutional deals that are happening now, institutional deals and transactions that will occur through the balance of 2020, and then address 2021 through 2022 in debt and equity markets. Mark Broughton with Merrill Lynch. Mark Broughton will be discussing equity markets, stocks, debt and equity through 2021 Q2. So from the beginning of 2021 all the way through to Q2, I think that's a short enough window. Commodity markets, gold and oil through 2021 Q2, and currency markets through 2021 Q2. Erich Guenther, Glacier Real Estate Financing, will be framing his comments and his advisory around loans, 1 million to 20 million, the lending landscape as it is today, the debt coverage and principal paydown, LTV and reserves that will likely occur through the economic conditions that we have now. Erich will also be addressing industry sectors, hotel, restaurant, airlines, car rental, Airbnb, and convention now through 2021 Q2. So you'll get a look of kind of what it was like, what led up to this, what the deal flow, what the conditions will be like going forward through 2020, and then Q1 and 2 of 2021, what's expected. All right, I'll turn it over to the panelists. Jack, thanks very much. I appreciate it.
Yeah, hopefully you can hear me okay. And sorry, I'm just on the phone. Yeah, I've been with the bank for, this will be 33 years in real estate since 1991. And I guess the current situation would be my fourth, let's call it, downturn or event. First being S&L, next the dot-com, followed by 2008 crisis, and now we have the disruption caused by the coronavirus. And one thing I would say, and it's an interesting time to try to forecast right now, what I'm saying a lot is every day feels kind of like a week, and I think a lot of you can kind of relate to that. But one thing about this, where we are right now, is the downturn, to the extent we have one, is not being driven by excess, too much debt, too much cash out there. That was kind of a hallmark of the other three. And I think a good thing as well is the banks are well capitalized and kind of aligned more so with the government than perhaps the situation was in 2008. There's more of a common, let's all figure this out together, versus back in 2008. So, I think near term, what we're doing, and I think what we will see for the first half of the year, is really dealing with our clients, dealing with issues that they're having. And our clients are developers, funds, private real estate companies in construction, acquisition throughout the Pacific Northwest. We have about a $2 billion portfolio, and we have regions like this all around the country. So what we are seeing right now is clients coming to us, telling us what their situation is, whether it's a work stoppage, whether it's tenants asking for relief, whether you're a hotel and your occupancy has gone from 75% to 20% in 30 days. Kind of putting out fires right now. I think that we're going to be like that for the next 3 to 6 months. Back to my point about bank capitalization, banks are well capitalized, and we are in a position to lend. And we are seeing transactions through that were in the pipeline when all of this hit pretty rapidly. We're honoring, mandates that we have. Clearly, a lot of our pipeline has slowed down as customers reassess what they want to do. I think customers are trying to remain as liquid as they possibly can, and they're being very proactive, reaching out to their tenants. So there's going to be a lot of this back and forth, and I think if you try to reach your banker, they're going to be really busy doing a lot of things. So expect things to slow down a little bit when you have a request, because a lot of them are coming in. So we need to work through all of that. And I don't want to get into epidemiology, but, that is kind of going to be something that's going to determine where we go. And the hope being, if this slows down in the summer, and we've kind of put out the fires, we've kind of seen where we all shake out, there will be a rebuilding once people get back to work, as this wasn't driven by too much capital out there. It's driven by something else. And I think that will allow us to recover more quickly once we get people back to work. But we are in the market. I just think the near term is going to be extremely busy with very granular customer requests driven by their tenant base or their project or whatever. And I think after that, the future is a little bit more uncertain. I do think rates are going to stay low. I don't know if my other panelists agree with me or not, but my personal opinion, it's not the bank's opinion necessarily, is rates are going to be low for a while. And I think that's a good thing. So that's my 2 cents for right now. I'll just happy to come back and answer questions or whatever after the other panelists talk as well.
All right, Jack, thank you very much. Really appreciate it. Mark?
Hi, can everyone hear me okay, hopefully? Thanks for the time today. What I thought I would do is give you a little bit of my background for a second and then talk a bit about the various markets and today's environment, try to put a little context around that and how we see kind of the coming year unfolding in all the different areas, be it equities, fixed income, commodities, and the dollar and such. So I've been in the investment industry for a little over 30 years, working mostly on the equity investment markets, managed various mutual funds and such for some larger institutional accounts, and spent for the last few years working on the wealth management side, so dealing with the full wealth, wealth planning effect and such. But my real history has been in managing mutual funds and portfolios, so I have a lot of history in the equity markets. What I thought I would do is start and provide just a little color on how we're thinking about the decline in the markets today, kind of put a little context around that, and I can expand from there. So, we've had quite a dramatic drawdown in the equity markets over the last number of weeks. We went from a high back in February of 33.86 to hitting a low only 21 days later on March 23rd of 22.37. That was a 34% decline. One of the fastest, it was the fastest decline that we've seen entering into a bear market in the last 100 years. And if you go back over the last 50 years, you'll find that we've had 6 similar sell-offs, crisis bear markets that we've been involved with. And, so we look to those different periods to try to get some understanding and confidence around when an equity market might make a bottom, what we might see in the way of trajectory for recovery, coming back to more normalized markets, coming back to old highs, those sorts of things, just to provide some background and really pulling from a history of crises that we've seen. What we found is all crises are different. Every time there's a different element that starts those. Either you look at 1987 and the crash there, you look at the dot-com bubble, to the great financial crisis and such, Great Recession, all these different elements, they're always different with items that start them. And when you're in the heart of the crisis, oftentimes people say, well, they're unknown how you're going to resolve these. But really, that really is what creates a crisis, not having the way out. The colleague I work with likes to say, if you're watching a scary movie, it's never scary the second time, but the first time when you don't know the outcome, that's when it can be unnerving. So if you look at where we're at today, we've come pretty aggressively off the bottom. One of the things that we do know in looking at these past 6 crises is that 1 year post the lows, in each one of those environments, the market's been up 20% plus. And we're already up 20% off the lows, but that's something to look forward to, is kind of evidence that a low can be made and see progress off of that. The real question is, when do you see sort of the return to old highs and some of the more normalized markets? If you look back, you'll have years like 1987, where it just took 1.8 years to get back to the old high. That was the shortest of these periods. Then if you go well back over the past 100 years, and you go back to the correction back in the Depression, that took almost 25 years to get back. But of course, that did have the Great Depression and a World War in the middle of it. So I'd say it's a little different than where we're at today. And that is one of the things we're looking at quite strongly, is kind of where we're at today and what brought on this crisis. As we just mentioned from Jack, this isn't a typical correction. It's something that we have, I want to say self-induced, but we have this mandated stay at home is creating this environment, not the typical where you see excesses built up in the market and then need to be kind of reversed. So we're at this point in the market where we've had a big run back up. One thing I would add is that we continue to be a bit cautious in the near term. We think this will be a period that needs to sort of work its way out as the numbers from the economic picture begin to unfold and we really see the extent, which we know will be bad. It wouldn't surprise us to see a retest in here of some of the old lows or a pullback in the market after the strong move we've had. If you look at the last 100 years, there's been 16 periods that have seen similar 30% return drawdown, and 14 of those were followed by recessions. In all 14 of those recessions, the average time for recovery back to the old highs, or I'm sorry, for the time for the market to make a low was 11 months. We made a low in just 26 days. So it wouldn't surprise us to see continued choppy markets in here, and we think it's good for people to prepare themselves for that. But let me spend a moment on just sort of the drivers of this economy. So Bank of America, we continue to, every week, as Jack mentioned, each day seems like a week, but every week we are constantly trying to refine our forecasts. Right now, the current forecast, we see GDP for the year down 6% in 2020. We see, if I really want a little shock and awe, we expect a 30% plus down in GDP in second quarter, followed by another down quarter in the third. And we see corporate earnings coming in really dramatically lower in this coming year. We originally went into this with an earnings figure of 2019 of about $163 for the S&P 500. Most expect that to drop to somewhere in the 115 to 120 range, about a third cut. It could even be deeper if companies just decide to roll everything into that. The real question, again, is how long it will take for us to recoup those earnings on the other side. If you look at a great financial crisis, it took 4.5 years to get back to the earnings level. The Great Depression took 8 years. We see it very differently today. In kind of thinking about the year ahead, we see a much quicker rebound to rebuilding earnings power. A couple things to think about. Think about the S&P earnings. One is that it's a very different complexion today. We've got today about 75% of the S&P is comprised of what we consider to be growth or sustainable earnings base. The other 25% of the financials, industrials, materials and such, but technology, healthcare, consumer represents about 75% of the index. That was about 50% when we were in the Great Depression, and financials, things like that, were twice as high. So it's about a sustainability of earnings today. One example of that would be if you went back to 2008, you looked at energy. Energy at the time was 3x the size of software in the S&P 500. Today, the software component is 2x the size of energy. So you can see kind of the complexity of the markets today, much more growth oriented. I think that'll help drive and improve earnings growth in the year, coming out the other side of this. I would say, again, the other things that we really focus on here are the fact that it is being self-imposed. And so, we're not going to need the long length of time to burn off the excesses that have been created in one industry or one area of the economy. The response has been dramatic and quick, quite a bit quicker than 2008. The bills and things that have been put forth and both the fiscal and economic relief that we've seen put together in the last number of weeks has come at 1/3 the time it took in the 2008. So we think the response is strong, will help with that. What we're watching really closely for kind of a bottoming of the markets are really looking at a number of things. One being, of course, COVID and everything happening there. We find that really in any of these past crises, you always need to resolve the core issue. So in the .com, it was finding kind of the time and the energy when the strongest of companies bottom and were able to reemerge on a right track, and the smaller challenged companies kind of went away. And then during the Great Recession, of course, it was the right stimulus put together to mark a bottom in, the fear that people thought we were going to have widespread, companies, falling out of, bankruptcy and things such as that. We're at a period now where, we need to see just what we're seeing today, flattening of the curves, but then also fair treatment for the antivirals, as well as, of course, to see the hospitals, strain on hospitals to be improved. So that's one thing we're watching. We're also watching a number of real-time elements. We get every Thursday a claims number, unemployment claims. That's one of the most real-time measures we can get. There's been dramatic spikes in claims. Tomorrow we're going to see, last week was 6 million, and we could see that again. Tomorrow we expect big numbers to be in front of us. But watching the second derivative of that will be important to see when that growth seems to stabilize. Will be important. And then lastly, one thing we have proprietary to Bank of America is we're the biggest issuer of credit cards across the country. And so we have, every week we do a really extensive review of credit card data, and we publish this weekly. And it provides a real-time picture of what spending is looking like. And you can imagine what we're seeing real time over the last week. You can see, airlines, we had declines in airlines of over 100%. You say, how can we be down over 100%? Well, people are getting refunds for tickets they already issued, and then they're not spending anything. We've seen overall consumer spending down about 60%, which is just a dramatic drop over the last week. And so again, watching that week in and week out, and of course, you need to have some freeing in the economy, or the stay-at-home policies to begin to have that spending come back. But then to watch and see what that spending comes back at will be critical. One of the things we've seen, we get similar data out of China, and what we've seen, and as they've returned back to work, you've seen you've seen the factories come back on board, you've seen energy usage come up, you've seen all these different elements come up to 85, 90% of normal capacity. The one thing that you've not seen is travel and entertainment come back up. It's still down like 50, 60%. And I'd explain that to more of like a PTSD. Once you kind of go through this, the fact that you're just gonna up and leave your house and go out and start transacting again, I think, or traveling again, is something that I think we're gonna have to work through here as well. So there's definitely some periods that we think will be important to monitor, some areas to monitor, to see kind of how we come through this and come out the other side. Touched on a couple of the other elements, asset classes. The fixed income side, we very much agree with Jack that we think rates are going to stay low for much lower for much longer. If you look at the 10-year and the 30-year treasuries, go back 10 years ago, we had rates in the 4 and 5% kind of category. Today we're sub 1% on the 10-year and 1.3 on the 30-year. But we could see those moving a little bit higher as we get through this crisis. But we see a sustainable kind of upper end of that for a long period to come. It's our view and my view that it's a generational type of trend. I believe that the 30-year, we're not going to see over 4% in my lifetime. I consider myself still pretty young. So the rates we think stay low for a long period of time. A lot of that has to do with continued low levels of inflation. If you look at commodities and gold, we think those are going to continue to be challenged as there's going to be lower demand. Inflation is going to be kept low for a longer period of time. A lot of people worry about all the support that's being brought to bear on this issue, and will that lead to inflation over time of the monetary policy? It's our view that we're really in a position now to be staving off deflation, and we're not worried at all about the return of inflation. We think it'll stay along for a long period of time. That will also support a stronger dollar, we think, going forward. The last thing I would say is just a comment on kind of how we're thinking about the markets and what we're doing these days. The sectors and stocks and things that we like to know. We're positioned in our strategies today, looking for what I would term as kind of middle of the road dividend payers. We're looking for not the aggressive high yield, the 15% plus yields. We're looking for companies that are paying good solid dividends in the 3 to 6% range, where we think those are stable and consistent over time. I think it's going to be a real continued quest for yield going forward. We find today that in the equity markets, if you look across all the different strategies that people are invested in, across individual wealth. Over half of that money invested is invested in income strategies looking for yield. And that has risen over the last 5 years as rates have remained low. So finding a higher yielding portfolios with good stable growth is important. We like growth over value, mostly because we believe that coming out the other side of this, some of the leadership that we've seen in the past will continue, given all the different innovation that's going to continue to mean needed to drive solutions post, this new world post COVID. We like a kind of theme of global to local, meaning that we think a lot of the supply chains and the major infrastructure that's been built has already begun to look at, kind of shortening those supply chains, but we think that's going to be even more significant going forward, given that we've got such a, obvious understanding now of what it can be like when supply chains get disrupted on a global nature. That can help industrial companies overall. And then lastly, just the move from offline to online. And of course, retail and commerce has experienced things for so long, but I think, it's forcing us into the world of financial services continuing to be an important element. All different types of elements, technological advances will be born out of this. And I think, there's just the innovation that kind of goes back to that growth over value belief. So with that, I'll stop and we can, I guess we'll take questions at the end, right, Gary?
Mark, thanks very much. Well, I think I might have, should have had this question for Jack, and I don't know if Jack is still on. He was called in as opposed to being on the Zoom platform. So I'm going to tee this up. This is from an anonymous attendee. This is my understanding, I'm quoting now, my understanding is that getting funding for new projects was difficult after 2008. Would that be the same this time around as well? Mark, you're welcome to take this question, or Eric, you can take this question. What do you think, you guys? Getting funding.
Yeah,
Jack?
This is Jack. I'll start off. Hopefully you can hear me. I think it's going to be more difficult getting funding than 60 days ago. But to my earlier point, we're well capitalized. We are in business. We're not on our heels. For things that make sense, I think funding should be available. Again, going back to earlier points, banks are spending a lot of time working with existing customers who are, working with issues in their portfolios and coming back and forth. So just the nature of time in the day, things are going to slow down a little bit. But I think, the in business, the lights are on, not on our heels kind of posture is definitely, we want to fund and make loans to support the economy. Now, that being said, there needs to be an economy. And that's what we're all watching right now. Real estate's very dependent on a lot of different things, particularly employment. And to the extent employment is impacted, obviously it's going to be impacted short term, but seeing where it shakes out, that's going to drive a lot of decisions. But the body language and the position of the institutions, I think, are much better than 2008. Totally different deal. We just have to have some type of economy to lend into.
Okay. And Jack, I know we had another question. You may have it there. We are seeing most lenders raising rates for purchases and refinancing by 150 to 200 bips. This is opposite to what the Fed and the White House want. This is not productive to the healing of the economy. What is causing this? Why is it occurring? Rates are not as low as you say.
Yeah, I would say in terms of spreads, we have increased our spreads from before. And part of that is because we view it, there's more risk in the economy right now in lending the money, driving the rise in spreads. That being said, in this rate environment, even with the increase, they're relatively low rates. But spreads are it's not just a real estate phenomenon. Across the board, corporate bonds, what spreads are going up, and that's just a reflection of more risk inherent in the economy and more risk making loans. To me, it's that simple.
Okay, thanks very much. Now, and I've got, and please feel free to continue to surface your questions. I'm going to go down the list here, and I'll do a couple more, and then we'll hear from Erich. So Armin wants to know at least one hard money, private money lender in this area who I won't name, but is one of the half dozen most well-known around here, has suspended lending. What is up with that? Why, when might lending resume? What are the other hard money lenders doing, et cetera? Can someone comment around that? Erich, give it a shot.
Sure. I think a lot of the, or a fair amount of the hard money lenders are actually pretty active. I think their pricing's very expensive right now, and they're just taking advantage of uncertainty. And I'm thinking about, Pyatt Broadmark or Columbia Pacific Advisors. Those guys are in the very high end of hard money. A lot of the debt funds, just because Wall Street's kind of pressed pause, we've seen a lot of debt funds stop lending at the moment and unwind a lot of commitments that they were moving forward on. So I would say that the better price debt funds have definitely pressed pause and just want to get through probably the next 10 or 15 days and kind of understand what is really happening with collections, rent collections, specifically on retail and as well multifamily. But
okay. Thanks, Erich. Thanks very much. And then Keith, this is more of a comment, but I think it's because of the problem with durability of future cash flow for apartments for at least the next 6 months. So regarding cash flows, do you think that risk is being priced into new loans or Erich, what do you think?
We've heard from, Fannie and Freddie that right now, and this was just a couple of days ago, that they're likely going to reserve a year worth of payment, which effectuates, just brings your loan down about 5%. So maybe instead of 70% leverage or 75, I think the fix right now is to reserve more and bring down the leverage.
All right. Well, Erich, that's a great segue. So go ahead and let's start your presentation regarding loans and the future landscape, the industry sectors, and take it away.
Sure. I'm Erich Guenther. I'm with Glacier Real Estate Finance. I've been in the industry for a little over 15 years. We have a dozen plus life insurance companies that we also service for. Right now, I think we've seen just a very rapid deceleration, specifically on hospitality and retail, obviously locally with businesses shutting down. So we've gone from originating deals very quickly to communicating with borrowers and trying to figure out what the month of April is going to look like as far as collections. And so far, the jury isn't, we don't know exactly what that's going to be, but it does look like retail is getting, and it's tough to quote, but I don't know, 30 to 50% non-payment, maybe more. So we're starting to work with or in between our lender and borrower. Hospitality is awful. I mean, about mid-month, we went from, 60, 70% occupancy down to single digit. We've also seen a lot of hotels in the Seattle market actually just close or mothball for a couple months and see what kind of occurs in the next 60, 90 days. I think a lot of people are focused, or a lot of our borrowers are focused on managing their liquidity right now and trying to structure safe deals for everybody, for themselves, for their tenants. Nobody wants to lose their tenants. They've spent a lot of time working with landlords with their tenants. So just trying to preserve that relationship and income stream. It does nobody any good to put the screws to anybody right now. So we're just trying to convey that with lenders and put together reasonable workouts for everybody. What else?
Keep going. What do you think about airlines, car rental, Airbnb, and the convention business, travel, the cruise lines, what it means for local income, et cetera?
I think travel is a big question spot and very concerning. Obviously, conventions everything's been pushed off till third or fourth quarter, tons of cancellations. And I guess everybody's hoping that we get some semblance of an economy coming back so that we can see third and fourth quarter pick up. We have seen, especially in the hospitality segment, a lot of people pushing out conventions or rebooking for fourth quarter. Yeah.
Okay, so coming out of this, and feel free to comment. First of all, I'm gonna surface a question here that came through on the chat versus the Q&A. So, how do you expect these market changes to impact sales in the market? And this is open for everyone. How do you expect it to change? I guess deal volume. What's going to happen to deal volume?
This is Jack. It's still early. I mean, obviously, I think it's going to decrease. And it's also kind of, we'll see at the same time. I mean, we have several clients who are in the process of selling. Let's say have 4 interested buyers of a particular type property. One seems to be 2 dropped out, and I'm talking over the last 3 weeks, you know, just to give an idea of time frames here. 2 have dropped out, one's not sure, and one wants to move forward, but the client is not sure if they're going to move forward or not, and thus has asked us for a longer term extension. So they don't have all that much time left on their loan. So they don't want to be put into, if I am selling now, someone is going to try to lowball, just by nature of where we are right now. And I don't want to sell in that environment. So I think in general, transactions will slow. I think right now there's a lot of discovery going on. If I'm under contract or a letter of intent or whatever, can this person close? Are they going to come back to me and ask for a different price? What have you? I think that's all playing out as we speak right now.
Thanks, Jack. Anybody else want to comment on that?
I would agree with that. We're working on several transactions midstream under contract, and the big issue is rent collections. And what's the month of April look like? And of course, does the price of the transaction need to be reset based on collections and how deep that goes and how long? So I would say definitely transactions, acquisitions have slowed down significantly.
Thanks,
Yeah,
Eric.
and what I would add, we have a couple of different clients who are business owners and are actually going through periods. One that was supposed to close, restaurant sale, it was supposed to close in March and is being pushed out to late the summer. We think that's still probably optimistic. We have another manufacturing client of ours that same sort of timetable, an early summer, probably ends up later in the year. I work with a lot of investment bankers, and you know, it's our belief that there's probably a 6-month window in here where things just don't get done, where people are really focused more on their own balance sheets and less so on trying to get something facilitated. Of course, coming out the other side of that, there's also a number of people that will be looking for opportunities to sort of help those that are struggling, and you can see maybe acceleration once we get through post into the end of the year and next year.
Thanks, Mark. Eric, this is a question from you from Ted Wood. Ted Wood asks, Eric, what do you see for multifamily lending in the next 1 to 3 months, rates, reserves, et cetera? And Eric, if you could touch on loan to value, rate, reserves, debt coverage ratio, and what the balloon's going to look like, what the bullet's going to look like if they're going to shorten those up. Go ahead.
Yeah, there are a lot of different perspectives out there at the moment. I would say you've got agency lending and then banks and credit unions. Banks and credit unions, I think, have definitely pulled back, not wanting to do cash out, want to work with existing clients, not really wanting to push the envelope. Rates recently, like as of yesterday, I think I have a 10-year fixed quoted around 3.75 or 3.65. I think rates are going to be somewhere between, depending on the term, probably 3.5 to 4, 4.25. As I said, with agency, it sounds like their fix at the moment is to collect 12 months of debt service at closing, which is going to reduce your leverage by roughly 5%. I think overall, less leverage. As far as DCR, I mean, you're back to kind of tier 2, 3, 4. Tier 2 is like a 125. At tier 3 is 135 debt service coverage ratio. And so as you're lower, your interest rate's going to get a little bit better. A lot of our life companies right now have effectively pressed pause or said, hey, if you want to take something at 5% or 4.5%, we'll do the deal. But generally speaking, most borrowers right now are pressing pause, trying to figure out what their collections are. And I would also say this based on some comments with some of our clients. The mid-tier kind of B and C properties seem to have less rent collection issues than some of the lower and higher, so kind of high rise, we think are going to see a tough time with rent collections because people are going to tighten up and move to better priced properties, I think.
Okay. And then what do you see for retail financing? So the average investor that has a small strip mall, maybe 4 to 12 suites, and how does an investor ameliorate any failing tenants, working with brokers to bring tenants, dispositioning? How do you see that?
I think retail is really tough right now. I think we need to wait and get through the next, 60, 90 days to kind of see where things end up. Unfortunately, on the restaurant scene and local, it seems like a lot of restaurateurs are going to go out of business. They had such a short amount of liquidity. At the same time, seeing a lot of these PPP loans come through may actually give them a little more breath to get through the next 60 days. So I would say the other thing that's obvious right now is getting a hold of a banker that does do SBA lending or some of these loans is borderline impossible right now. They are all just swamped with requests for immediate liquidity to kind of keep the lights on and hopefully have a prayer of hanging on to their business.
Okay, and this is probably a good question for Jack or Eric. How is this impacting appraisal values? How are appraisers viewing values at this time going forward? Jack?
This is Jack. Jack, this is still a work in process. Interestingly, we did have a appraiser looking at a project, and he was, I forget where this was in Washington, but he was approached by someone, maybe a police officer, asking what he was doing, in a stay-at-home environment. So that was a little anecdote. obviously it's going to be impacted. I mean, what we saw in 2008 was a huge shift in values to the downside. And, loan to value is, so values are going to come down. Cap rates are going to go up. There's no question. And retail, even in, normal times, retail, I've noticed, can have varying cap rates, even with well occupied, just depending on how it's located or configured. So I think it's going to be especially challenging in the retail world. We will see on the lodging side, but my guess is it's going to be pretty significant. And I think part of it is due to uncertainty, and I think part of it is due, we're in a downturn right now. Just for whatever reason, appraisals are going to come in conservative just for that fact, which is what we noticed again in 2008. So it will be interesting to see. We don't have anything in process where I can give you data to that point, but that is my guess from past experience in 2008.
Thanks, Jack.
I would agree with Jack. I think definitely they're going to come in much more conservative, and probably the biggest losers are going to be retail and hospitality. I did read a report that TREP put out recently, and they were running some modeling on default rates compared to the Great Recession. And I believe that they were talking about default rates peaked at around 16% across all asset classes. And they felt that this, and maybe a little too early to tell for sure, but they felt that the default rates, and this was, I think they took 2,500 securitized loans that were performing well, and they thought that the peak of the default rate would be around 8%. But mentioned as high as 30 or 35% in lodging or hospitality.
Okay. Vicky has a question. She's a local hotel owner, and Vicky asks, in Washington State, properties were selling for about 5 to 6 times gross before the virus. Do you guys see market prices coming down? Eric, Jack?
Yes, absolutely. I think prices are going to come way down. I have no idea what number. I mean, when you have hotels literally shut down and zero income, it's pretty tough to understand how much that will impact. I couldn't give you a number, but it's going to be significant.
Okay. Jack?
Yeah. I mean, I agree. I clearly in the short term, you don't want to be marketing anything. I think the real question will be, what's the rebound going to be, as a travel question in general? How fast do people get back out there? When do they get on airplanes again, even when given the all clear? So I think it's too early to understand all of that, but yeah, there's no question there's going to be some changes there, in the midterm, I would say anyway.
And I would jump in. One other thing that is probably going to fundamentally change is work and business travel. Obviously now we're all experiencing, connecting via web and whatnot, but I wonder how significant of an impact or fundamental change that will be. One of the first things we saw early in March was, Amazon, Facebook, Google stopping all of their corporate travel. So the question is, how long does that take to come back, and does that change fundamentally?
Yeah, from public perspective, I just was talking yesterday with our hotel analyst and hospitality analyst, and kind of spent some time walking through the modeling of how does this come back, and he clearly feels that this is going to be one of the groups that are going to come back the slowest. Even if I mentioned about economies bouncing back or being more resilient, again, it's that delayed effects of what are the lasting things you see coming away from a period like this. And we do believe that, there'll be more people shifting to an environment where travel will be less dependent, more focus will be on video and things such as that. So we think, right now, I think he's predicting, getting back to the volume we were at probably a couple of years out. So that's going to impact earnings growth over this period. Revenue growth also going to impact valuations. So probably be one of the last things to come back, I think.
Thanks, Mark. And Mark, while you're here, John Isaacson has a question really asking of Erich, but I think that Mark, I want you to comment on this as well. On gold and commodities. Now, John didn't ask if it was pricing or volume, but could you give us kind of a perspective on where you see gold and commodities?
Sure. Our view on gold, there's been a lot of back and forth and different variants here as the market has gone through this period where people had thought that gold would have performed a bit better. There's some people we follow that expect gold really to break out in here to have a real upside as you begin to move through this crisis. And if it prolongs, people are looking for more safer assets and a store of value. It's our view that over the long term, it's really a hedge against inflation. And we feel that inflationary pressures are going to stay low for a long, long period of time. And so in that environment, we're not really drawn to the commodity. You can understand how it's potentially used to buffer volatility in a period like this. If you think of raw materials and such, like I mentioned, we have a real belief over the next number of years, there is going to be a move from more global to local. Ajay Kapoor is an analyst, he's worked with us for many years, great strategist. He's based in Hong Kong, just did a big report for us on bringing the supply chains back, not necessarily just back to the US, but shorter supply chains to other parts of Asia and such. And we just see a real, that's going to create more of a pull for infrastructure here domestically, and in these other areas are going to, we think, help commodities over time. But there is a ceiling. They're not going to move to, too far beyond where we're at today. Global demand still kind of was dependent on so much of this. But if we had to look over the next 5 years, I think, commodities are going to have a place to move higher.
Mm-hmm. Mark, thank you. Erich, did you want to comment on commodities right now or take another question?
Not my area of expertise, sorry.
All right, Fred McConkey Development asks, tenants are asking for and receiving rent concessions. What are lenders doing in response to loan modifications? What are you guys seeing on that? You and Jack, Erich.
Everybody's trying to be responsive. I would say the securitized loans are reacting much faster. Everybody is working. So, I mean, I feel like we'll have immediate sorry, go ahead.
Go ahead, Jack.
Yeah, I think the desire is to try, again, contrasted with 2008, is to try to figure out a way to help. But that said, also it's really a conversation, probably a series of conversations. What is your plan? What are you doing? What are your resources you can apply to help with that? And understanding that as well, trying to work something out. But the bias this go round is to try to, understand there are things out of people's control. It's not driven by too much debt on a property or something like that. What can we do to help? I mean, clearly I'm just going to use real life stuff. Things are emerging, but on hotels, we've got a hotel we're trying to work with them on. We're asking them questions about their resources, as well. But at the end of the day, we're going to figure out a way to work something out with them.
Yeah.
So it's very much case by case. But I guess the message I'm trying to get across is there's an openness to it. It's just understanding in detail what the plan is. That's kind of the key word. Coming to your lender and saying, here's my plan, here's what I want to do, and here's why I want to do it. And here's why I'm asking you for help. That's a very helpful way to approach that issue.
Thanks, Jack.
Yeah.
I've got another question in here from Kathy Christie, and I've got to compliment Kathy because this is a great way to tee up a listed property for sale. She says, I'm the listing agent on a $1 million Tacoma Med Services building that is being repurposed for DSHS group type housing requiring social services and government permits and sign-offs to complete their feasibility segment. And closing dollars are coming out of Texas. Do you see the probability of a price renegotiation on this type of transaction? Eric or Jack, do you want to, Eric or Jack, you want to comment on that? No? Okay. We don't know. Could be. Who knows, right? Okay. Jeremiah Durr, thanks for your question here. With appraisers and inspectors unable to visit properties, are lenders still making loans to close without traditional due diligence being complete? I don't see that happening in underwriting, but what do you got? I don't see it, but.
No, I don't see that. I see traditional underwriting standards staying. I think there is a lot of conversation about using just video oriented stuff. We were just on the phone this morning talking to a multifamily owner that was talking about putting up video walkthroughs for their units and whatnot, but I don't think that anybody's gonna lower their underwriting standards because they can't.
Yeah.
Yeah, I would agree. I mean, things are going to take longer, like I said earlier. These things can get done, just not as quickly, perhaps, in the near term. But we're trying to be accommodative on minor things, funding a draw or something like that. But on a closing, yeah, it needs to be right.
Yeah. Okay. I'm going to take this last question here because our time is almost up. In multifamily, this is from Carl, in multifamily, we are seeing preliminary numbers on delinquency and finding 50% of this due to employed persons with other income choosing not to pay because of state blanket eviction ban. So what Carl's saying is that his delinquency from tenants is based on a permissiveness that is engaged by the state or local government authority with eviction bans. So Carl asks, what metrics do you see governors using, or I guess those in authority of either state and local government using to lift these bans, whether or not these eviction, stay of eviction will be reduced? Do you guys have any comment on that, or if that'll be shortened? Or if it'll be changed to a party that is definitely affected from a COVID-related loss or a COVID-related incident? Evictions. Anybody? I don't see it changing.
Yeah, this is Jack. I can't address the larger question. Just one real-world example. We have a client that renovates apartment units in the suburbs and recently closed a transaction with them. And due to that issue, among others, they have pretty much changed their renovation plan, moved it out significantly in time, and just changed the strategy of how they're going to, it's going to move much more slowly than they had planned. And that's how they're kind of dealing with it. So I think they have probably some of the same questions as the person asking the question, but that's kind of a hot off the press example. They're just extending out their plan by over a year.
Right.
And they're going to run at a higher occupancy, meaning you can renovate fewer units, and it's just going to take longer.
All right. Well, Jack, Mark, and Eric, thank you so much for joining us today. That completes our question and our Zoom presentation. If there's additional questions, please submit them through email. We'll make sure the participants are forwarded the questions. And on behalf of the Washington State CCIM chapter, the board, just a minute, I got to check my chat because somebody's chat. Okay, so thanks everybody, and appreciate it. We'll see you on the next Zoom teleconference. Have a great day.
Great. Thank you all.
All right.